Futures trading requires margin. The exchange looks at the price movement of the underlying contract in order to determine the risk associated with trading. The volatility of the contract and its nominal value are used to determine the required per-contract margin. Margin is also known on some exchanges as a performance bond. Simply put, this is a good faith deposit required from the investor to be held by the exchange in the event that the contract price moves against the investor. Trading on margin. Futures trades are performed through margin accounts. Cash deposited in a margin account is used as needed by the broker as a good faith deposit to guarantee the performance of an investor's contracts. Trading on margin requires the customer to sign a margin agreement and to abide by the broker's margin rules. Futures margin is determined by the exchange on which the contract is traded, but higher requirements can be set by the broker. Different instruments carry different margin values. Initial margin. At the outset of a trade, the broker deducts an initial margin payment from the individual's account. The money held by the broker is intended to act as a good faith deposit in the event that the trade goes against the investor. Such margin amount shows that the investor can back adverse movements in the value of the underlying investment with assets held on deposit with his broker. Maintenance margin. Initial margin is relaxed after an opening position has been held overnight. The broker reduces the amount that the investor must have in order to maintain the position. The investor must comply or else runs the risk of having positions liquidated by the broker. Additional funding required to stay within the minimum maintenance amount is known as variation margin. Daily limits. Many exchanges deal with excessive intraday volatility on futures contracts by setting daily limits. These are the maximum permitted movements in the intraday price of the contract. Often, those movements are the same as the value of the maintenance margin. An investor holding a long position in a market that subsequently declines to its daily limit down price would face losses equivalent to the size of the good faith deposit held by his broker. This protects the exchange, clearinghouse, and other investors from both disorderly markets and unnecessary losses.